Michael Burry manages a multi-billion-dollar fund, Scion Asset Management, and he is famous for The Big Short, where he shorted the housing market just before the 2007 crash that kickstarted the Great Recession. But that's not all. He successfully called and profited from the dot-com bubble of the early 2000s in tech stocks. And more recently, he predicted the recent downturn in the stock market, calling for a crash in everything from Bitcoin to software as a service stocks way back in 2020. And he was proven right once again when the market dipped in early 2022, right after Burry exited most of his stock positions. But Burry thinks we have only seen the beginning of the market crash, saying first we will see a drop in multiples and then we will see a drop in earnings, which in a full-on economic recession will completely crash stock prices. And we've already seen Burry's predicted drop in multiples. We can see that while most companies' revenues keep increasing, stock prices have dropped, meaning the multiple that the market is willing to pay for earnings has been trending down, kind of like the number of videos I've been posting recently. Sorry, I've been sick. But now we're going to turn our attention to the second half of Burry's prediction, where companies will start making less and less money as the US moves into a full-on economic recession, causing stock prices to fall even more. In fact, Michael Burry estimates we're currently only halfway done with the current market correction. So welcome to FinTech, and in this video, we'll be looking at the recent stock market drop to see how Burry knew that the correction was coming. And we'll then look at the latest data coming out of companies like Meta and Apple that show Burry's predicted recession is already here and is just starting to impact company earnings, which means we may be in for another drop in stock prices. So hit the like button if you want, and let's get into it. So the first market drop that we've already seen hitting stocks has been in the form of multiples compression, something which Burry has been warning about since at least 2020. Early last year, Burry was not shy about voicing his concerns over the rise of meme stocks like AMC or GameStop, calling for their crash back in mid-2021. His argument was that these stocks were caught up in a speculative fervor caused by rampant money printing from the Federal Reserve that was feeding into retail investors' pockets. Now, retail investors are just regular people who invest, so not big hedge funds or pensions, and the availability of cheap cash caused many of them to jump into investing in 2020. But this access to easy cash didn't only affect meme stocks. Burry also called out stocks such as Tesla, saying enjoy it while it lasts back in early 2021 after that stock saw a historic rise in price. And if these prognosticating tweets weren't enough, Burry's Twitter account turned into the equivalent of a fortune teller on a Ferris wheel. One day he would post a new tweet and the next day he'd take down his whole Twitter. Then he'd tweet again, take it down again, and around we went with Burry's predictions getting bolder and bolder as he went. Burry soon expanded into calling out everything from Bitcoin to EV stocks to software as a service stocks, saying they are like the housing market in 2007. And he even went so far as to say we are headed for the mother of all crashes around 1 year ago today, saying losses will approach the size of countries. And with the decline in indexes like the S&P and the Nasdaq since November of last year, Burry seems to have been right that we were headed for a correction. But Burry's early predictions were all based around this idea that we were in a stock market bubble. Prices were inflated due to money printing by the Federal Reserve. But once those prices declined, the market should settle down and go back to normal, right? Well, it turns out Burry is now seeing new headwinds for the stock market. Now that we've finished the multiples compression stage of stock prices just resetting back to baseline, now we're headed for the next stage, earnings compression. And the cause? A global economic recession that will hit company earnings and thus their stock prices. Burry's just a regular bag of sunshine, isn't he? So an economic recession is defined as a sustained downturn in economic activity. In the US, one of the most popular rules of thumb has been 2 consecutive quarters of gross domestic product or GDP declining being needed to declare that the country is in a recession. And well, the US just saw its second quarter of declining GDP growth. So does that mean we're already in a recession? Well, officially, a recession has to be declared by the National Bureau of Economic Research, or NBER. But this organization tends to be very conservative in labeling recessions. They can take between 4 to 21 months to label a recession, and often by the time they do officially officially declare we were in a recession, the economy has already recovered. So they're more of an organization that looks back at where we were a few months ago than one that looks forward to try to predict the future. But that hasn't stopped billionaires and fund managers from giving their opinions. With Elon Musk predicting a recession last month, multi-billion-dollar fund manager Cathie predicting we are already in a recession, and most importantly, Michael Burry tweeting multiple times about the risks of a US recession, even calling out the White House for, quote, redefining a recession, and seemingly implying it was being used as a political term rather than being based on the data. See, the White House does not think we are in a recession, and they issued a statement saying that. They say that 2 quarters of negative GDP growth are not enough to prove we are in a recession when we factor in positive economic signals like low unemployment and consumers not becoming reliant on credit cards to pay their bills. And let me tell you, there's a whole rabbit hole you can go down trying to figure out the weird political/financial world of declaring whether or not we're in a recession. But fundamentally, it doesn't actually matter that much to stock investors. What really matters is whether or not companies start to make less money than they did before. Because if companies are making less money, their stock prices are going to decline. It's exactly what Burry mentioned in his first tweet. First, we saw multiples compression. Now we are going to see earnings compression. So let's take a look at a few high-profile companies in the technology space, since those are the kinds of companies that I invest in on this channel, and see if we're starting to see signs of earnings problems that could indicate a second crash in tech stocks is coming. And if Burry is right that we're only halfway there in the stock market correction, we may soon see a large adjustment to our net worths to the negative. But one of the biggest factors in how wealthy you become is how much money you actually make from your job. And when it comes to making money, it often comes down more to who you know than what you know. Inch is a free app for professional networking, allowing executives, experts, founders, and investors to expand their networks in a goal-oriented way. Inch goes beyond traditional networking tools in that it allows its over 100,000 users to exchange professional favors, sharing expertise, and making introductions, which makes it a lot more actionable than something like LinkedIn. And you can get started for completely free using the link in the description below. Here's how it works. You can post a request almost like posting on social media, and Inch's algorithm will match that with relevant people from across their network, not just people you're directly connected to. This makes it easy to expand your network by trading favors, building your personal brand, promoting your product or service, or even getting paid. I can log into the app, say who I want my request to go to, write up my request, including any details that I want, and then share it out to the world. I'll include a link below if you want to answer the request that I just made directly. So if you're looking for a better way to network with people using concrete favors that work kind of like the real world rather than just following people on LinkedIn, plus connect to a network of over 60% founders and C-level executives, then go ahead and sign up using the link in the description below. And now let's get back to the video. So to understand if we are already in the earnings compression stage and about to see a second stock market drop, we need to look at the earnings of actual companies to see if they have started dropping. Now, there are a lot of factors that can affect a company's earnings: labor costs, raw materials, consumer spending, but we're going to focus on a single number to compare how companies are performing today versus previous quarters. And that is revenue. How much money are companies actually bringing in? Now, this obviously doesn't tell the whole story, but it makes for a convenient way to analyze companies quickly at a high level, and it's something that you can do with the companies in your portfolio. And we'll look at 4 companies, 2 big ones, Meta and Apple, and 2 smaller, more software-focused companies, Zscaler and Snowflake, to give us a view of what's happening in the tech space. So Meta reported their latest earnings at the end of July, and they showed their first ever drop in revenue year over year. So for Facebook's entire existence as a public company from 2012 until now, they've had at least some revenue growth, and it has finally dropped into the negatives. That seems to support Burry's theory that the recession is hitting Meta, but it could also simply be due to Apple restricting Facebook's access to data on the iPhones, a move that was expected back in February to cost the company $10 billion in revenue this year alone. And considering Meta's revenue is down just $0.8 billion from where it was a year ago, that one change by Apple could be responsible for Facebook's entire drop in revenue. So it's not conclusive evidence that the recession is hitting companies. But let's look at Apple next. Apple also reported earnings last month, and they actually saw record high revenues being driven by strength from iPhone sales and services. And considering how expensive iPhones are, that seems to be a good sign that consumers are still willing to spend money. But to be fair, Apple Apple is one of the biggest companies in the world, so maybe they're the exception rather than the rule. So let's look at a few smaller tech companies that I invest in. Zscaler is a cloud security company. They protect internet-based companies from getting hacked. So if companies are spending less money on security due to a recession, we'd probably expect that to show up in Zscaler's numbers. Well, Zscaler saw their revenue grow 62% last quarter compared to a year ago, and that basically matches their growth from the last 4 quarters, up 63% the previous quarter, 62% the one before that, and 56% the one before that. So again, no real signs of earnings compression for this company yet. Now lastly, we'll look at Snowflake, which is a company that manages other companies' data in the cloud. Just like databases were an order of magnitude improvement over spreadsheets, or cloud hosting was a magnitude of improvement over running your own server, Snowflake is an order of magnitude improvement in data storage on the cloud. And again, it should show earnings dropping if other companies are spending less money on their data services. And we do see Snowflake's revenue growth slowing. Its revenue is up 85% year over year, compared to their last 3 quarters where they grew revenue over 100% per year. So that is another negative report. Now, is that company just growing too big to keep on doubling its revenue every year? Or is that the effect of the recession starting to hit Snowflake? It's kind of hard to say at this point. But I don't think that there's clear evidence that companies across the board are seeing earnings compression at this point. And if we look at earnings across the entire S&P 500, they are actually up from where they were a year ago as of March 2022. Some companies are making more money than ever, and some are seeing their revenue growth slow. But what about Burry's prediction of earnings compression? Well, if Burry is one thing, it's patient. When Burry predicted the subprime mortgage crisis of 2007 that kicked off the Great Recession over the next few years, he made that original prediction way back in 2005. And for 2 years, his fund, Scion Asset Management, was just hemorrhaging money while they waited for the inevitable housing collapse. The fact is, Burry has been early in his predictions before. In fact, in response to generally business as normal earnings coming out this quarter, Burry tweeted, "These earnings reports and by Jove, the whole season have a last hurrah feel." So maybe the earnings compression won't hit until next quarter or the quarter after that. But when they do hit, Burry thinks that they will bring down stock prices substantially, which may very well happen, but it also might not. While Burry has correctly predicted every last major stock market crash, he's also predicted crashes that never happened. In 2019, he predicted that index funds were in a bubble and would crash, and that was 3 years ago at this point. And we have certainly not seen any weakness in index funds beyond the rest of the market. He also shorted Tesla stock and tweeted back in November that the company would fall in value by 90%. But he mistimed his short and ultimately exited his Tesla short without a substantial profit back in November 2021, which it turns out was not the best timing, as Tesla was at an all-time high around the same period that he abandoned his short position. Burry's consistent negative predictions about the stock market have led Tesla CEO Elon Musk to call Burry a broken clock, as in a broken clock is right 2 times a day. And if Burry is always calling for a crash, eventually he has to be right. Now, Burry's way smarter than me, but so is Elon Musk, and they seem to be contradicting each other. So my plan is to just pay attention to what Burry says, because he does often have really insightful comments about the economy, but I'm also not going to sell out of the market based on Burry's warnings, because if I did, I would probably never get back in. My plan is to continue to dollar cost average the majority of my money into a broad market index fund like VT Sachs, since that has been shown to be the best strategy for building wealth over the long term. Plus, it matches Warren Buffett's advice, one of, if not the most successful investor in history. Consistently buy an S&P 500 low-cost index fund, Buffett says. Keep buying it through thick and thin, and especially through thin. Make sure to check out Intech using the link in the description. Don't forget to like and subscribe, and I'll see you next time.